One of the largest international financial institutions in the world, Morgan Stanley, just reported their year-ending results this morning, and the street gave us a rather surprising 7% increase in the stock price. And I mean, once we take a look at how they performed this year, you'll likely be just as surprised. Altogether, however, since the stock began its decline back in 2021, the business is down now just 8% or so, despite navigating a challenging interest rate environment. So with that in mind, we as value investors must ask ourselves if this is the perfect chance to pick up shares in anticipation of a further rebound, or if this stock will end up heading lower for longer. I mean, especially if you're looking for some financial sector exposure, stay tuned because we'll answer all those questions and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. We will be kicking this video off with an analysis of this business's fundamentals and their strategic plan going forward to transition the business further. We'll go through the top line, bottom line, balance sheet, cash flows, and finally we'll end up concluding this business with an analysis using our intrinsic value calculator to see what buying points are present with this business. And if you do enjoy the video, smash the like button, subscribe, because it really helps out the channel, and we post on here regularly analyzing the businesses that you are most interested in. So make sure to comment your next video recommendation down below. With all that out of the way, let's jump into the analysis. All right, and we're starting with Morgan Stanley's Q4 2022 results, and well, let's take a look at what happened. As you can see immediately, and the reason why I said this is actually surprising that they're actually almost back to where they were just in September of 2021, well, it's because their investment banking revenues, a huge segment for them, is down 50% from last year as a result of less mergers and acquisitions. They've had severe impacts to the global equity underwriting volumes. And that leads us to our next segment of this business, which is their equity. Net revenues are down also 24% from a year ago. So huge hits to this business in some of their biggest segments. And they said they had a hit to equity mainly because of their markdowns on certain strategic investments. What they're trying to say here is that as a result of the market declining, right, a lot of their equity naturally will also decline. And so that's why their revenues are down on that side. But their fixed income net revenues, those are actually up about 15% from last year as a result of their stronger results in their macro and credit products due to higher client engagement. So that's at least one positive takeaway here. But something else to note here is that this is a huge business, especially in the financial sector with wealth and investment management. They're considered the #1 business here and the leading financial institution in that space there. They're also the top 3 in the institutional security space. So this is a huge business with a strong grasp on the market. And so it's important for us to analyze businesses like this as they help us understand a little bit more about the institutional side of the broader market here. So with all that being said, let's look at their financial summary now, coming in with this quarter's revenues at $12.7 billion. And so once we've deducted for our expenses and our costs to produce those revenues, we're left with pre-tax income here of about $2.7 billion. Okay, and from a yearly perspective, $53 billion in revenues this year, $14 billion in operating income. And when we compare that to last year's quarterly and yearly results, we can definitely see we've had a significant drawdown here on a year-over-year basis across the board. And so we can really see right away this year was a bad year for them. That is a massive hit there. But does that mean that they are a failing company? Well, not necessarily, as they have had consistent expansion of their wealth management profitability. You know, of course, growth isn't going to be completely linear, but they have ultimately been growing year over year, and we can expect that, just as they are, to continue to grow in the future, leading to higher profits. And again, we mentioned earlier at the top of the video that they are a global leader in this space and that they're expecting to grow further as they look to maximize their growth potential in the future as well. So that's also something you can expect from this business. As you can see, they do like to grow through acquisitions here, definitely acquiring a ton of different businesses. And then whenever a business no longer fits the bill, well, they also divest, right? So that's what you can expect, a lot of mergers and acquisitions to further grow this business. And it's done pretty well for them over the past few years. Ultimately for 2022, it led to what I call an intrinsic return of about 9%, because as the stock price still declines, you won't have received a 9% increase on that front for the year of 2022, at least, as we saw earlier. But intrinsically, your shares have increased about 6% in value, and you've also received a dividend as well for this year. So, I mean, again, if these are things that interest you as an investor, you'll definitely want to look further into whether or not you want to invest in a business like this. Altogether, repurchasing shares at lower prices than last year, that is a good sign. We want to see shares being purchased at their historical lows rather than historical highs. So definitely a good sign that shares are being repurchased at lower levels, but I suppose it's understandable considering the environment we are in. Now, that leads us to this latter stage of the video here where we're trying to make an investment decision on this business. We can see here, we look at the operating income, they've been able to consistently grow year over year over year. Now, this last year though, gaining up to about $19 billion in operating income. We can see now after reporting this year's full year's earnings, they came in with about $14 billion in operating income, a decent decline there of about $5 billion or so in earnings. We're going to want to see over the next few years, can they actually achieve higher levels of operating income, higher levels of earnings from this business and get back to that 19 billion where we can start to further grow up into 20 and 25 billion, you know, across the next decade or so. So if we jump into our calculator here and if we expect that over the next year or so they can produce about $15 billion and we see a bit of recovery here in their operating income, if we require a 10% return and they do pay a dividend as well, if they can grow at just 5% for the next 5 years at a normal rate, which they have been over the past decade or so, that stabilizes out at about 4%, let's just call it 3% going forward on a 14 PE like they're currently trading at. The stock should actually be back up into $143 per share right now. After the share increase, they're up to $97 per share. So you can expect almost a 40 to 50% increase in the stock price in a normal case scenario, assuming these calculators' expectations. Now, if we look at this from the best case scenario where we expect 9%, a strong recovery over the next few years, at least in terms of their growth, and then we see this normalize out over the next decade at, let's just call it 5% like they've normally been growing at, like I mentioned, on an 18 PE, the stock would be worth even $200 per share, so even a double from where we are right now in the best case scenario where we see an economic recovery across the globe. Now, in the very worst case scenario, let's say they continue on their decline, at least in terms of operating income over the next 5 years, they're actually not able to grow at all. They actually decline 3% on an average scenario over the next 5 years. Then they finally stabilize out. Let's just call it at 0%. They're not able to grow. So these are really, really bad results here. On a 7 PE, the stock would be worth about $71 per share. That's in the very, very worst case scenario, where Morgan Stanley, the leading business in wealth and investment management, it would be worth about $71 per share in that very worst case scenario. If that entices you as an investor where you could purchase shares now and expect that in the very worst case scenario, they only get down to $71 per share, or at least you knew that they'd be worth at least $71 per share, then yeah, this might actually be something that you're interested in investing in, especially if you're looking for that financial exposure to your portfolio. They're trading at a 2.6 price to sales, 1.7 price to book. So not terrible numbers at all. Price to free cash flow could be a lot better, but I mean, the business has shown a resilience to increases in the stock price overall. They do go through periods where they have down cycles. You know, this is a financial institution, so that is to be expected, where we do see, you know, some massive declines, especially in economic downturns. But then when things are good, we can definitely see the rebound is extremely strong here, where since 2008, they've already been up 620% from this stock and climbing. So definitely something to consider. That's the analysis for this video. Let me know what your thoughts are on investing in a business like this going forward. If you've enjoyed the video, make sure to like the video and subscribe, as it really helps out the channel grow. Leave your thoughts in the comments section below. And with that, I'll catch you on the next one.